Markets don't announce turning points politely. They don't send invitations. They don't hold press briefings. They reveal themselves under pressure when every force is applied, when fear is maximized, and when something that should collapse doesn't. What you are about to hear is not a forecast. It's a reconstruction. A step-by-step breakdown of a coordinated attempt to break the silver market, and the moment that attempt failed. Because when a market absorbs maximum damage and stands back up stronger, it isn't surviving anymore. It's sending a warning. They came prepared. They waited for thin liquidity. They waited for darkness. Margin requirements were raised. Paper shorts flooded the order book. The tape was driven red straight into the weekend. For 48 hours, the narrative was carefully planted. The silver rally is over. The crash has arrived. Fear did the rest. But when London opened this morning and price discovery resumed, the smoke cleared, and the bull was still standing. What we witnessed was not a bounce. It was not relief. It was one of the clearest structural signals the silver market has produced in over a decade. No press conference. No central bank speech. Just raw price action. The market didn't merely recover. It detonated. A violent gap higher erased an entire engineered sell-off in a single session. That does not happen in weak markets. That kind of move is a scream, the sound of a bear trap snapping shut, not on retail traders but on the largest financial institutions in the world. It was the moment short sellers realized their paper promises were no longer backed by physical reality. And more importantly, it confirmed something critical. Buy the dip is no longer a retail behavior. It has become institutional doctrine. If you sold into the panic, understand this clearly, you were not wrong emotionally but you were useful mechanically. You were liquidity. You were fuel. But if you held, if you understood the structure beneath the price, you are watching confirmation unfold in real time. This is not about predictions. This is a crime scene analysis. We are going to dissect how the banks tried to break silver, and why, for the first time in 40 years, the mechanism failed. To understand the violence of the rally, you must understand the trap that came before it. Markets never move cleanly. Bull markets are designed to eject participants. They are engineered to maximize pain, confusion, and doubt. The sharp, sudden drop we just experienced fits a textbook bear trap. Here's the process. Banks know exactly where stop-loss orders sit. Thousands of traders place automatic sells just below psychological levels, $60, $62. To access liquidity, those stops must be triggered. So a catalyst appears. A margin hike, a regulatory whisper, a frightening headline. Price is pushed just far enough. Snap. Stops trigger. Retail sells automatically. Red candles print. Bears interpret the move as trend failure and rush in aggressively, shorting with conviction. The narrative shifts instantly. Silver is heading back to $50. But here's the deception: the banks were never selling to exit. They were selling to accumulate. They pushed price down to create sellers. Then they absorbed everything. Contracts from panicked retail. Contracts from confident bears. Once their buying was complete, the artificial pressure vanished. Natural demand took over like a compressed spring. Price ripped higher. Overnight gaps appeared. Suddenly, sellers were left holding cash they didn't want, and shorts were trapped underwater. Now they had to buy. And their buying fueled the rally even further. This is not theory. This is exactly what just happened. The drop was engineered. The recovery was organic. And the speed of the rebound tells you everything about the strength beneath the surface. Weak markets bounce like dead cats. Strong markets bounce like tennis balls. Silver just bounced like a super ball. We've discussed the margin nuke before, exchanges raising capital requirements to force liquidation. Historically, it's been devastating. In 2011, it crushed silver nearly 30% in days and scared speculators away for a decade. They tried the same playbook again. Margins were raised. Holding positions became expensive. Initially, it appeared to work. Price dipped. Fear returned. Then something unprecedented happened. The market absorbed the shock. Why? Because the players have changed. In 2011, silver was dominated by over-leveraged speculators. When margin calls hit, they had no choice but to sell. Today, silver is dominated by industrial users, family offices, and sovereign funds. These are not gamblers. They are hedging supply chains and protecting national wealth. When margins increased, they didn't sell. They wired the cash. That single behavior shift is catastrophic for manipulation models. The banks miscalculated the pain threshold. They believed a 50% margin hike would break the bull. Instead, it barely slowed it down. When markets ignore bad news, it signals extreme underlying strength. Buyers are no longer price sensitive, they are volume sensitive. They care about securing metal, not about temporary costs. The failure of the margin nuke was the all-clear signal for the next leg higher. The banks fired their silver bullet and now they're standing there with an empty gun. Markets are driven by fear and greed, but there is a third force more powerful than both: regret. A V-shaped recovery is a regret machine. Imagine the trader who sold on Friday. He thought he was smart. He planned to buy back at $55. He went to sleep feeling safe. He woke up Monday locked out of his position. Now he faces a choice: admit he was wrong and buy back higher, or wait and hope. Most people wait. They watch price climb to $65, $68, $70. Regret slowly mutates into FOMO. Eventually they buy back at the worst possible moment. This is how bull markets accelerate. Shakeouts don't weaken trends, they purify them. They remove leverage, reset sentiment, and force skeptics to chase price higher. Technically, what we just saw was a masterpiece. Overbought conditions were neutralized without breaking structure. Whether engineered or natural, the result is the same. The path of least resistance is now higher. But here's the key detail: retail didn't buy the dip. The volume shows buying began in Asia and exploded in London. And that changes everything. For decades, London has been the suppression engine of precious metals. When New York panicked into buying, London calmly sold. It was the seller of last resort. Today London didn't sell. London panicked. Aggressive bids slammed the tape. This is a fundamental change in market character, like watching a firefighter pour gasoline instead of water. Why the switch? Not ideology. Liability. The answer lies in the float. Inventory and float are not the same. Inventory is what sits in vaults. Float is what's available for sale. Yes, London vaults may show hundreds of millions of ounces, but most of that metal is locked away, owned by ETFs, sovereign funds, and long-term holders who are not selling at any reasonable price. The only metal that matters is the float, and it's gone. India didn't buy ETF silver. It bought float. Industrial demand didn't touch strategic reserves. It drained the dealer pot. The iceberg remains, but the tip has melted. That creates a liquidity crisis. When industrial giants need silver, price must rise high enough to force long-term holders to sell. That price is not $60. This is why London flipped. Now we reach the core of the crisis: leasing. Banks lease silver to industry, creating the illusion of endless supply. But consumed silver does not return. Solar panels, electronics, military hardware, it's gone. Now refineries can't replace it. Lease rates spike. The alarm sounds. Banks realize the silver on their balance sheets isn't in the vault. To fix the hole, they must buy physical metal regardless of price. This is the London pivot. Not speculation. Survival. Add unallocated accounts to the mix, fractional silver claims suddenly being converted into allocated bars, and you have a silent bank run. Not crowds at coin shops. Billionaires sending legal notices. They tried to scare this demand away. It failed. And that failure may define the next phase of the silver market. At this point, the roles are no longer theoretical. The banks are no longer referees. They are forced participants. We have the failed bear trap. We have the London pivot. We have a leasing system under stress. The stage is fully set. Silver is now trading in the low $63 range. And directly overhead sits the number that matters more than any headline: $65. This is not just another resistance level on a chart. $65 is the line of survival for the short side. Above it, the structure changes completely. Once $65 breaks, there is almost no technical resistance until the previous all-time highs. The chart opens up. The air thins. And control shifts violently. So now the question becomes simple: what happens next? Will US markets join the global buying wave when they open? Or will we see one final attempt to suppress the move? Because make no mistake, the float is gone, the banks are trapped, and the squeeze has already begun. If you've followed this analysis so far, you already understand the fundamentals. The crash attempt failed. London's supply vanished. Physical buyers took control. But even in a shortage-driven market, price does not move in a straight line. It moves from battlefield to battlefield. And right now, the entire silver market is staring at one battlefield: $65. We've recovered the Friday smash. Confidence has returned. But $65 is different. It isn't psychological. It isn't technical. It's liability. This is where the options market turns into a weapon. Let's talk about the gamma wall. In the derivatives market, traders buy call options, bets that price will rise. Right now, there is a massive concentration of open interest at the $65 strike for December and January contracts. Millions of ounces are effectively betting that silver breaks higher. That's fine unless you're the bank that sold those options. If silver stays below $65, those options expire worthless. The banks keep the premium. End of story. But if silver crosses $65, the equation flips instantly. The banks are now obligated, directly or indirectly, to deliver metal at prices below the market. That exposure forces them to hedge. As price approaches $65, market makers begin buying futures to neutralize risk. The closer price gets, the more they are forced to buy. And here's the trap. Their buying pushes the price higher, which increases their exposure, which forces even more buying. This feedback loop is called a gamma squeeze. It's what happened in GameStop. It's what happened in Tesla. And it's sitting directly above silver right now. If $65 breaks with volume, the market makers flip from neutral observers to aggressive forced buyers. They don't want to chase, but they have no choice. Price doesn't walk to $66 or $67. It jumps. This is the vacuum effect. Above $65, resistance doesn't fight back, it joins the rally. That's why you'll see extreme volatility around $64.80 to $64.90. This is where the banks will defend with everything they have. Paper selling. Stop runs. Headline pressure. But if physical demand from London and Asia keeps pressing, the dam will not hold. Now we approach the US market open, historically the graveyard of rallies. For years the pattern has been predictable. Asia buys, London buys, and New York smashes the price. The infamous mid-morning sell-off. But today feels different. What? Because American investors are waking up to the same catalysts that panicked London. Samsung's battery demand. China's export rumors. Empty vaults. And most importantly, the chart. Americans are momentum traders. When they see silver up $1.60 overnight, they don't think it's expensive. They think they're late. FOMO is a powerful force. We are likely to see retail money rush into silver ETFs at the open. And when ETFs receive inflows, they are forced to buy metal to back those shares. That creates another layer of demand, stacked on top of London's buying. But there is an opponent, the dollar. A runaway silver price signals inflation and currency weakness. Historically, this is when the dollar index is pushed higher to cool commodities. So the battle at the US Open becomes clear. Retail FOMO versus dollar defense. If silver holds firm through the morning session, if there is no sharp reversal, then the shorts are in serious trouble. It means the defense failed. It means the US joined the stampede. Watch volume. Rising price on rising volume confirms the move. Rising price on weak volume deserves caution. But given the structure created by Friday's bear trap, the odds favor the bulls. There is one more confirmation signal today, the miners. On Friday's drop, silver miners were crushed. Names like First Majestic and Pan American fell 4-5%, as if the rally was over. Today, silver is back near $63.50. Mathematically, miners should gap higher. If silver holds here, these companies are minting cash. But miners often lag at turning points. Equity traders wait for confirmation. Commodity traders don't. This creates opportunity. Watch the Junior Silver Miners ETF. If silver is up 3% and miners are only up 2%, that's not weakness, it's mispricing. That rubber band always snaps back. Once equity traders realize the rally is real, the catch-up trade can be violent. Now zoom out. The next 24 hours will be chaotic. You'll see spikes and dips. But don't lose the forest for the candles. Whether silver closes at $63, $64, or $66 today matters to traders, not to investors. The forces driving this move are structural. Samsung, China, empty vaults, leasing failures. Those don't disappear at the closing bell. Let's step back even further. The market just told us something historic. $61.50 is now the floor. Not long ago, $30 was the ceiling. Today, $61.50 is the level where billionaires rush in. That is a valuation regime shift. As we move into late December, we enter a powerful seasonal window. Window dressing. Funds must report holdings to clients. If silver is the standout performer and a fund owns none, the manager looks incompetent. So what do? They buy winners at any price, just to show exposure on December 31st. This creates forced institutional buying. Funds that ignored silver at $30, $40, and $50 are now compelled to buy at $63. They are price insensitive. They just need the position. That institutional FOMO is how markets go parabolic into year-end. And now ask the most important question. Which outcome causes the most pain? A crash to $50? That hurts silver holders who don't sell anyway. A rally to $75? That destroys banks, pressures industry, humiliates underweight hedge funds, and forces the public to chase. Markets move toward maximum pain. Right now, maximum pain is higher prices. Friday was the final attempt to shake you out. If you held, you aligned with the pain trade. And finally, the macro truth. This move matters because it confirms a wealth shift. For decades, value flowed from physical reality to financial abstraction. That tide is reversing. You cannot print a battery. You cannot print a solar panel. You cannot digitize geology. Silver gapping higher while bonds wobble is the market voting for reality. Volatility will increase. Swings will widen. You must harden your discipline. Accumulate physical. Hold quality miners. Avoid leverage. Let the smart money chase. We're already seated. The bear trap failed. The rocket cleared the tower. Now hold on.